Hello, everyone. Welcome to another session of Financial Accounting in the Wisest King Academy. I am Don Solomon, and it's always a pleasure reaching out to you with a valuable content as this one. Please, if you are new, do not forget to subscribe to the channel, right? And please give me a thumbs up and hit the notification bell to be alerted in everything that goes on in this house. Today we are going to be working on cash flow statement IAS 7, and we'll be looking at something very special: the operating activities. Operating activities. Wow. If you understand the operating activity, then you have understood the cash flow statement. Now, it is said that the cash flow statement can be prepared using either the direct method or the indirect method. And that is actually determined by the operating activity, because there are two methods used to identify the net cash flow from operating activities. They are the direct method and the indirect method. So today, we are going to start with the direct method. Now, remember, the cash flow statement is prepared with information from the income statement and the statement of financial position. And the operating activities is prepared using the income statement and the working capital elements, that's current assets and current liabilities. So we come back. There are two ways. Let's take the first way, the direct method. The direct method of determining the net cash flow from the operating activities. Now, with the direct method, the net cash flow from the operating activity can be calculated by taking the short-term cash receipts, the sum of the short-term cash receipt, and we subtract from it the sum of the short-term cash payments made within the period. Now, when we talk about short-term or operating cash received, we speak of, okay, let me write it. Operating cash received. We talk about things like cash sales and receipts from debtors, right? We talk about other cash income receipts. Cash income receipt, maybe for example, rent receipt, not dividend receipt. Dividend receipt, remember, is an investing activity. Rent receipt, commission receipt, are we together? Now, remember, there are other incomes that operating incomes, they may be operating or not, that are not cash incomes. Decrease in provision for doubtful debts, that is an income, that is not a cash income. So take note of that, right? As a few. We have profit on disposal of non-current asset. That is an income, that is not a cash income. Increase in revaluation of non-current assets. That is an income, that is not a cash income. Please, let's take note. So, with this, we'll take the sum of the cash received from debtors, the cash sales, and other incomes received, other cash income received. And from it, we will subtract the operating or the short-term cash payments. These operating cash payments, they are many. We have cash purchases and payments to creditors. Cash purchases and payments to creditors. Take note. We also have expenses, cash expenses paid, like rents, salaries, wages and salaries, commission, commission, advertising expenses, lighting and heating. So, cash expenses, please, not non-cash expenses. There are non-cash expenses. For example, bad debt, depreciation, increase in provision for doubtful debt, loss on disposal of non-current assets. These are non-cash expenses. they are not used here. Please, they are not used here, right? So preparing using the direct method, you simply take what? The sum of the short-term cash receipt or the operating cash receipt. You subtract from it the sum of the operating cash payments made during the period. And these are examples. Now, let's get this. Very, very important. The information used to determine the net cash flow using the direct method can be obtained directly on the face of the financial statement or extracted from the books using control accounts. Okay, note this. It is impossible to prepare the cash flow statement using the direct method if you have been given only the statement of financial position. I repeat, it is impossible to determine the net cash flow from operating activities using the direct method if you have been given only the statement of financial position. What does this mean? It means that to determine the net cash flow from operating activity using the direct method, you must be given both the income statement and the statement of financial position. So if you are asked to prepare a cash flow statement and you have been given the income statement and the statement of financial position, you can use both the direct and the indirect method. But if you are asked to prepare the cash flow statement, and you have been given only the statement of financial position, it is impossible. I repeat, it is impossible to prepare the cash flow statement using the direct method simply because you have inadequate, insufficient information. Okay, we are under the direct method. Now look at this. We said the information used to prepare the cash flow statement using the direct method. We are precisely the operating activity can be extracted, can be seen on the face of the financial statement, or extracted using control account. So the first thing we'll do here is total debtors account. Total debtors account. Now I'll say this. I'm going to make a complete lecture on control accounts where I'll explain it in detail. But for now, let's see how it works here. Now, here we have debtors brought forward. Debtors brought forward. We have an amount. Now we have credit sales. Credit sales or simply sales. This amount will be given in the income statement, of course. Now, here we have cash stroke bank. Cash received or check received from debtors. This is what we are looking for. Another thing to have here is returns inwards, discounts allowed. Are we together? Discounts allowed. Bad debt. Can I end there? Bad debt. Now, if you have something like dishonored check, you come here. Dishonored check. You will come here. Now, this account was balanced. Sorry, before we close it, we have debtors carried out. That's the closing debtors. These two values will be given in the statement of financial position. So take note. This account was balanced with Y and Y. So the missing figure that we are calculating here is it. The cash received from debtors. Cash and check received from debtors. Now, the sales ledger control account or the total creditors account is actually prepared to determine the cash paid, cash and check paid to creditors. Now we start here, we have creditors brought forward. Creditors or account payables brought forward. That's at the beginning of the period. Now we have credit purchases or simply purchases. Credit purchases or simply purchases, which will obtain on the face of the income statement. Now we come here, we have cash to bank, cash and check paid to creditors. That's a question mark. Now here we have returns outwards or purchases returns. Here we have discount received. And also our closing creditors. Creditors carried down. Now, this account was balanced. And you can see that this is actually the missing figure. So, this is how we calculate the cash paid to creditors. Now, in the case of expenses, cash expenses and cash incomes, notice if there were no prepayments and accruals for any cash expense, it therefore means that the amount in the income statement was actually the amount paid for that expense. If it's a cash expense, I repeat, if it is a cash expense and that there were no prepayments and or accruals on that expense, then it obviously means that what? That expense was paid in cash. What you see in the space of the income statement of the profit and loss account is actually what was paid. In a case where we have prepayments and accruals of expenses and incomes, it therefore means that what appears in the income statement was what was due for the period, but not actually what was paid. And so the expenses paid or incomes received can be calculated by preparing the following expense and incomes account. We take this. Now, this is an expense account. Now, expense prepaid are current assets. So if we have prepayment at the beginning of the period, prepayment or advance is brought forward. Expenses accrued or owed at the beginning of the period are current liabilities. So if there is, we write it here, owings brought forward. Now, the profit and loss account is debited with expense. So it means that we are going to credit the expense account profit and loss. We have profit and loss. This is the amount that is actually obtained from the income statement for that particular expense. Now, at the end of the period, take note. Or let me come here. Take note. We always say all expenses are debited. Actually, because when expenses are paid, the means of payment is credited. If we pay in cash, the cash book is credited. If we pay by check, the bank account is credited. Meanwhile, the expense account is debited. So I'm going to come here and put one. Cash flow bank. And this is the amount I'm looking for. Now, at the end of the period, take note. Owing is a current liability, and liability means a credit balance. I don't know if I've used this before. Look at this is 10,000. This is 6,000. Now, this account has a debit balance. So, where will the balance carry down go? It will come on the credit side. You can see that. So, here, owing, expenses owing at the end of the period means it is a credit balance. So, we need to take it to the debit side. So, here we are going to have owing carried down. Meanwhile, prepayment, expense prepaid is a current asset, debit balance. So at the end of the period, we take it to the credit side. So prepayment carried down. So this account was balanced. And so the difference that we have here is the missing figure. That's the cash paid for the expense during the period. Very, very important. Okay, the last one now is it's not actually the last, but let me check this also. The income account, yes, income account. Income is the exact opposite of expense. Exact opposite. Now, what does that mean? Look at if expense prepaid is a current asset, it means income received in advance or income prepaid is a current liability. If expense accrued or expense owing is a current liability, it means income owing or income accrued is a current asset. So you are going to have owings brought forward. You are going to have prepayments or advances brought forward. Exactly opposite. Now, usually incomes are credited in the profit and loss account. So it means that here I'm going to debit the income with profit and loss. Profit and loss. This amount is extracted from the income statement. Now, all expenses are credited. Actually, because when we receive all income, all incomes are credited. Actually, because when we receive an income, the money is debited in the bank account or in the cash account. Meanwhile, the income that gives us the money is credited. So we are going to have a cash stroke bank, which is what we receive, and is what we are looking for now. Now, at the end of the period, remember owing is a debit balance. So we come on the credit side, owing carried out. And remember, prepayment here is a credit balance. So we come on the debit side. And the account must balance. So the missing figure, that is the missing figure. We can see that. We can see that. Now, I'm going to throw an additional account. There was something I did not add. There's another expense, maybe tax. Let's say there were taxes. Now, I'm going to say this. Taxes paid for the period and taxes of the previous period. Other things being equal. So if in a case where we have been given only the statement of financial position, we have been given only the statement of financial position, the tax of this year will be paid next year. Meaning the tax that is paid in this year is the tax of the previous year. That is why things like taxes, dividends, right, they are under current liability. Actually, because they are calculated and paid, or they are paid in the course of the next exercise. They are incurred and paid later. But there are cases, like I earlier said, dividends may be paid, proposed and paid. Take note. Or dividend may only be proposed. Because when you see under the current liability, it means they were only proposed. So if they were only proposed, the portion that was paid in this period or in the period is that of the last period. But the question you ask, what then do we use the taxes, the dividends of this period for? We are going to use it to prepare to calculate the net profit before tax, which we are going to see under the indirect method. So, for now, let's remain here, right? So, in a case where we are using the direct method, and in our income statement we have taxes, and now under our current assets and under our current liability we have corporation tax also. Now, it therefore means we need to prepare the taxation account. And since it appears under the current liability, it means it's a credit balance. So balance brought forward will come here. It will be the same thing like this. Right? Now, since tax is an expense, and it means that in the profit and loss account is debited. So I'll come here, I'll put profit and loss, which is actually the amount of tax in the profit and loss account. Now I'll come here, I'll put cash stroke bank, which is what I'm looking for, the amount of cash I paid during the period. And now I have here what? Balance carried down, which is the closing balance of the tax under the current liability. So this account will only be prepared if I've been given the income statement and I have tax there, and I've also been given the current liability and I still find tax there under the current liability. So what if I have tax in the income statement and under current liability I don't have tax? It therefore means that tax under in the income statement was the total amount of tax that was paid in the period. Very, very important. So if I don't see dividends, if I don't see taxes in under current liability, it therefore means that the dividends and taxes in the income statement were actually those that were paid in the period. So that is it. That is it about the various adjustments to be done for the indirect method. Now we are going to pick up an example. Let's look at this example. The statement of financial position of the Wisest King PLC for the years 2012 and 2013, and the statement of income for the year ended 31st 2013 are as follows. Now we have the statement of financial position. Now the first element, we have assets. Under asset we have cash. 2013, 2012, 26,000 and 10,000. The figures are summarized is 000. Now we have account receivables, we have inventory, we have prepaid expense, we have plant and equipment, less accumulated depreciation. We have long-term investments, and under long-term investment, there is an increase in it. Now, we have total assets, liabilities, and stockholders' equity. We have accounts payable. We have accrued liabilities. We have bonds payable. Please, bonds payable is actually a long-term liability. We have deferred income tax. We have common stock, that's capital, and we have retained earnings. If we go down, we have the statement of the income statement. We have sales, we have less cost of goods sold, we have gross margin, that's gross profit, less operating expense, we have net profit, then we have non-operating items as loss on disposal of non-current assets. That is another expense. And we have income before tax. There were less income taxes, which is 48,000. Then we have the net income. Now, remember we have deferred tax, right? Under current liability, under the liability section. And also in the income statement, we have also tax. So we need to prepare the tax account. Now, note, dividend of 48 million francs was paid in 2013. The loss on sale of equipment of 4,000 or 4 million reflects a transaction in which equipment with an original cost of 12 million francs and an accumulated depreciation of 5 million francs was sold for 3 million francs in cash. Now, required, use the direct and the indirect methods to determine the net cash provided by operating activities for 2013 and prepare a statement of cash flow for the year ended 31st December 2013. Okay, we are going by the direct method. And to go by the direct method, we simply want to analyze the operating cash incomes and the operating cash payments. And remember, here, the income statement, the cash flow statement is prepared using the income statement and working capital. So let's start by them. We are starting. The first thing, we see sales. And sales, if we go in a statement of financial position, there is the presence of account receivables, that's debtors. If there is account receivable present, it means that sales, part of sales was in on credit. And by so doing, we need to prepare the sales ledger control account. Now we look at purchases. Well, we don't have purchases, we have cost of sales, so we calculate purchases from the cost of sales. But we also have accounts payables. If we have account payable, it therefore means that either part or all of the purchases were on credit. And by so doing, we need to prepare the purchases ledger control account. As far as expenses are concerned, in the income statement, remember they said less operating expenses, which is 352,000. Yes, and it did not include the loss on disposal of non-current assets, but actually it includes that expense includes depreciation. Because if you look at the non-current asset, if you look at the accumulated depreciation for 2012, it was 194,000, and 2013 it was 218,000. It therefore means that the depreciation that took place in the period is a particular amount. I am not taking this difference because I am told that there was a disposal of non-current asset in the period, and if there is a disposal, the asset disposed, even the depreciation is removed. So we are going to look at that. Okay, let me really calculate the net cash flow from operating activity using the direct method. Please, I'm precising direct method. Now, with the direct method, let me first of all prepare my sales ledger control account. Sales ledger control account or total debtors account. Now, I have debtors brought forward, which is account receivables. Now, brought forward, let me say 2012. Let me use dates. My account receivable for 2012 is 270,000. 270,000. The figures are 000. Summarize 00 up. Now, I have sales. I go in my income statement, the value of sales is actually 1 million here. Now, did we have something like returns inwards, discounts allowed? No. Dishonor checks? No. So here I'm just going to have the cash from bank received from debtors. Then I have debtors carried down. That's debtors for 2013. And the debtors for 2013 as account receivables is 180,000. I have a 180,000. So this will be 1,270,000. 1,270,000. So if I subtract, I'm going to have 000, another 0, right? If I subtract this, I'm going to have 9. 9, and I'm going to have a 0, and I'm going to have 1. 1,090,000. That is the amount received from debtors. 1,090,000. That is the way it is gotten. Now, straight, let's also determine the purchases ledger control account. We are preparing this to actually determine the value of cash paid to creditors. So we have creditors brought forward. Creditors for 2012. That's accounts payables. Account payables for 2012 is 310,000. Right? Accounts payables for 2013. Creditors carried down, that's 2013, is 230,000. Now here I have purchases, which I don't know. And here I have cash from bank, which is the amount paid to creditors. I don't still know. But I have cost of sales. Cost of sales is opening stock plus purchases minus closing stock. Remember here, I have used debtors already. That's the income statement. And that's the statement of financial position, that's working capital. I've used sales, that is income statement. I come down now. I'm using purchases, creditors, stock, and cost of sales, which income statement and working capital statement. Now, here our cost of sales here is 530,000. This is 530,000. Our opening stock, if we look at inventory at the beginning of the period, was 160,000. 160,000 plus purchases minus the closing stock is 205,000. 205,000. Now we look at this. This minus this, we are going to have 45,000. That's negative 45,000. So if I take negative 45,000 and bring this, it becomes positive. So it means the purchases will be equal to 575,000. That's the value of our purchase. So we come here 575,000. So if we add all of this, we are going to have 885,000. 885,000. So I'm going to have a 5,000 here. Alright? I'm going to have a 5 here. And I am going to have a 6 here. 655,000. That is the amount of cash paid to creditors. If I take one of this, that's 5,000. 5 plus this, 8. This plus this, 8. So that's 655,000. That's the cash paid to creditors. Now, another important thing here is the expenses. Now, let's look at the expenses. I'm going to open the expense account. The expense account. Now, I have prepayment. Prepayment for 2012. Prepayment for 2013. I go. Now I can see prepaid expenses. I have 20,000 and 17,000. This is 20,000 and this is 17,000. Now I also have, do I have an accrual? Okay, I have accrued liabilities. That's like accrued expenses. So accruals for 2012, and I have accruals for 2013. Accruals for 2012, 60,000. In 2013, 70,000. Now here I'm going to have profit and loss. Now, this profit and loss, we need to take the amount of the total expense, which we have here as 352,000, 352,000 minus the value of depreciation. Why depreciation? Because depreciation is a non-cash expense. We did not pay money for it. And also, if you look at loss on disposal of equipment, it was given under. So if it had been included in this amount, we will also subtract it. But when we give the depreciation, no, we're not giving depreciation. So let's look at the depreciation of the period. How do we get the depreciation? To have the depreciation of the period, take the accumulated depreciation for 2013, which is actually 218,000. We subtract from it the depreciation, the accumulated depreciation for 2012. But now there is an issue. Normally, if there was no disposal of non-current assets, I was taking this minus this and I have it. But there was a disposal of non-current assets. And when an asset is disposed, the cost is removed, the accumulated depreciation is removed. And remember, at the beginning of the period, the asset disposed, its accumulated depreciation was included here. So we need to remove it. And if we go back in that additional information, we're told that an equipment with an original cost of 12 million and an accumulated depreciation of 5 million. So I need to subtract the 5 million from here. Was disposed. So I have this. What is going to be the depreciation for the period? The depreciation for the period will be, if I take first of all 194,000 minus 5,000, which will give me 189,000. And I take 218,000 minus my answer, gives me 29,000. The depreciation for the period is 29. So come here and say minus 29,000. So it means that all the other expenses were paid in cash. 352,000 minus 29,000 was paid in cash. So let's get it. So we take 352,000 minus 29,000. It means that the expense that was paid, that was due for the period, which were cash expense, please. We had 323,000. So let's balance the account because the account was balanced. This plus this plus this. Come on, let's go. We are going to have, if I take this as a plus 77,000 plus 77,000. That's going to give me sharp 400,000. 400,000. Now if I subtract, this is 90,000 from 400,000, we will give the cash that was paid for the expense, right? So it means it was 310,000 that was paid for the expense. That's the amount of cash paid for expenses. And now, lastly, we are going to prepare our tax account. We have accrued tax. Accrued tax was given. Okay, we have deferred income tax and it appears under liability, which means it's a liability. We have balance brought forward. And deferred income tax for 2012, balance for 2012, which is a brought forward. We have 8,000 and balance for 2013. Deferred tax is 15,000. Now, if we go to the profit and loss account, what is the value of taxation? Less income tax. Income tax was 48,000. And so, how much of the cash paid for income tax? Now, we are going to have here 56,000. 56,000. And this is going to be 41,000. That's the amount of tax that was paid during the the period. I believe if you look at it keenly, we have touched everything that pertains to income statement and the statement, the current asset and current liability. Let me try to think. We have touched sales, we have touched cost of sales, we have touched operating expenses, and we have touched income taxes. So that's all. For the working capital, we have touched account receivables, we have touched interest, inventory, we have touched prepaid expenses, we have touched account payables, accrued liabilities, and deferred income tax. So you see, we have touched all what pertains to the income statement and the working capital. So let's try to determine the net cash flow from financing activity. So we are from operating activity, we are taking operating activity. So if you look in the income statement, there was no other income. So it means that here we only have cash received from debtors, which here is written as sales ledger contract account, 1,090,000. 1,090,000. Now we come here now, we need to less payments to creditors. Payments to creditors. How much did we pay to creditors? According to our purchase ledger contract, we paid 665,000. 655,000. 655,000. How much did we pay for expenses? We paid expenses paid. We paid 310,000. 310,000. And the tax that was paid during the period was 41,000. 41,000. So for some all of this, what's going to be the total? $655,000 plus that's going to be 351,000. It is going to be 1,006,000 sharp, which will subtract the net cash flow from operating activity using the direct method of pay. You have said 1,090,000 minus my answer. We have 84,000 positive. So take note, the net cash flow from operating activity is 84,000, and we are going to do that of the indirect method and solve the same question and see if it ties if we have 84,000. So if you find this video useful, please don't forget, do not forget, share it to others. Right? I greet you if you're watching from Nigeria, if you're watching from Kenya, Ghana, Tanzania, Malawi, please, you are highly welcome. Subscribe to the channel. Please share the link. Those studying accounting, financial reporting, whether a professional course or at the university level, please subscribe to the channel. In our next video, we are going to see what is all about using the indirect method and how to prepare the net cash flow from operating activity using the indirect method. And we are going to solve this same example. Thank you very much. And until next time, remain blessed. It has always been a pleasure serving you.